Hi everyone. Today let's take a look at a critical market that is sending its first warning signal. Then we'll take a look at all of the longer term charts as we get ready for this week of trading. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So a critical market is sending its first warning signals, and let's take a look at what we got here. So you can see we're looking at bonds and we're looking at the spread between high yields and those single B notes. So you can see single B versus triple C. And as we pushed into that .com bubble here, you can see the spread between high yields and the spread between triple C's started to widen as we got into that .com bubble. And that is what we're seeing here now. So you can see those single B's staying at a very low level, but triple C's starting to elevate, similar to what we saw here, same kind of spread. And then that created a much deeper pullback, and eventually single B's did come up with it. So we're starting to see that yield spread widen between these two, which could indicate a spike in company failures, which would wipe out the interest of anybody paying on those bonds and hoping to receive those yields. And just to talk about the sectors a little bit more, you can see triple C bonds are more in media, consumer products, high technology, things that tend to do worse in a tougher economy. And that's a worrying trend, right? So we're starting to get early indications that those weakest markets are starting to see those spreads widen, indicating an increased risk within the weakest sectors. But B-rated bonds have not started to catch up with those yet. And really what they're highlighting is this is the same pattern that we saw before the .com bubble popped. And what they're calling this is really the AI bubble. And we've called it that multiple times on my channel. And in terms of actionable pricing, they say you can go short high yield, HYG or J&K. Talk about J&K a lot on the channel. Probably not the best case to go short, maybe buy some puts, longer term dated puts, something like that potentially. And there's better ways to play this. You can short yields directly, but this is an option. Taking a quick look at fear and greed, you can see we're down to a 27 from a 39. Last week we were at a 45. So markets have been very bearish. We peaked out around 63 on the 15th, and now we're into those almost extreme fear conditions. That's below a 25 marker, so just barely above that. Seems like we're going to hit that 125 EMA. We've been saying that for a while. That's at 52.46. Continues to trend up slowly as markets continue to trend down. Strength still hovering though, which is interesting. This is the NYSE strength, 52-week highs compared to those 52-week lows. So strength on the NYSE still doing okay. Breadth starting to roll to the downside. We saw that on the charts on Friday, and you can see put call ratio, extreme fear, volatility, extreme fear. That got all the way up to a 29 at one point on Friday. And then safe haven demand and junk bond demand, both of these cratering here. People are trying to lock in some yields, and equities don't seem like a good place to be, at least in the short term. Moving over to the sentiment survey here, you can see the bulls actually stepped up slightly. That's not going to factor in the moves that we saw at the end of the week from the Thursday and Friday sessions, as this is typically taken on a Thursday before the close. So we'll see how it plays into next week. But right now the bulls are hanging in there quite aggressive. Bears barely staying above those relative lows at 21. So sentiment still very bullish, which to me indicates that markets can continue to fall. Moving over to seasonality, this is a seasonally weak period when it comes to regular years. Of course, we are in an election year, so you can see August tends to be a little bit better during this period. Of course, the first couple days of August have not been great. We're definitely seeing a lot of weakness there, so I don't know if this is going to hold true for this iteration, but just understand this is generally what it looks like. And then looking at the calendar here, you can see Thursday, very bearish. Sure enough, it was. Got all that data on Friday, also bearish. And then as we get into this week here, we do have a little bit of data. ISM services, consumer credit, wholesale trade. And some of these are pretty decent. Up 12, down 9, up 12, down 9 here for that Wednesday, Thursday. Not super great, but not terrible. And then as we get into next week, that's when we're supposed to see a little bit more bearishness towards the end of the week. Monday of options expiration, up 19 of the last 29. So maybe not so great this week, but we can start to see a bounce into that options expiration. Moving over to the earnings calendar, you can see Berkshire B, biggest company for Monday, Realty Income, Simon Property Group. I like those companies quite a lot, and I do own those in some of my passive accounts. And then you can see Tuesday, Amgen, Caterpillar, Uber, Duke Energy. Marathon Petroleum, Yum Brands, Super Micro, that'll be interesting. See how semis are doing. Global Foundries also could be an indicator there. Looking at Wednesday, you have Walt Disney, CVS, Hilton, Global Payments, always interesting to kind of get a pulse on that. Marathon Oil. And then for Thursday, you get some of those healthcare names, Eli Lilly, Gilead. Trade Desk, always fun to watch. They have not been doing so great along with the rest of markets. And then for Friday, you have Evergy to round out the week. And then looking at the economic calendar here, you can see global composite PMI, global services PMI, ISM non-manufacturing employment, non-manufacturing PMI, non-manufacturing prices. For Tuesday, not a whole lot. Pretty light on the data this week overall. 3-year note auction, interesting. 10-year note auction, see where those interest rates are sitting after the FOMC last week. And then for Thursday, 30-year bond auction, initial jobless claims, that's going to be super heated. Need to see that pull back a little bit if markets are going to hang in there. Otherwise, I expect that to be pretty hot and pretty bearish. And then there's really nothing for the Friday. So markets are going to do what they're going to do this week. Not a ton of uncertainty and not a ton of earnings, as we are pretty much past all of the biggest companies and all of the biggest data, at least in the short term. Moving over to Max Payne here, you can see Max Payne's all the way up at 547 for this week. Stock price 531, so we're way below it. Bottom of the calls is quite a bit lower actually, and it's kind of a grinding price action. You could argue maybe 537, but really 529, 530 is the bottom here where we start to see just a few calls in there. And that's where we're at already, so you could argue that's a little bit bullish. Maybe we see a swing back into the middle. I would call the middle somewhere between 545 and 550, which makes sense. That's where your Max Payne is, generally right in the middle, where the most options expire worthless. So if we get a little bit of a normalization, that would be at least a 2.5% up move. So something to watch here. Max Payne looks a little bit bullish, but total options is only 500,000, so not a huge impact. Moving over to the chart, starting off with the SPX here, you can see this is the monthly view. We did expect a down month. We did get a down month. And pretty surprisingly, honestly, it's only down 3.18%. I guess if you argue from the previous month's high, we're down closer to 6%. And if you include the wicks, about 6.5%. So it does seem a little bit more than that. But on the month, from a closing basis to a closing basis, it's only 3.18%. Momentum stepping to bearish, RSI stepping to bearish. So far here for August. I guess all of that's happened in just a few days. July, on the other hand, ended up positive 1.13%, wicked those long-term trend lines, and now we're pulling back. 9-month moving average is down around 51.78, which sits right in the zone of trend lines. I would guess that's probably where we're headed. So from current price, that's about another 3% lower. And then looking at that weekly chart here, you can see 3 weeks in a row of down move. That's what we got last time before we started to see some bounce. Hit the 21 EMA. Again, that's what we saw last time. If it's going to bounce and continue this kind of grinding trend higher, this is where you would expect it to do it. It did hold that trend line here at around 53.30. If this zone breaks, however, the next trend is sitting down there in that 52.29 area, which does correlate with that 125 EMA that we saw on Fear and Greed Index. So we'll see how it plays. Is this going to bounce and we're going to see another move like this to another record high, potentially up around the 6,000 area? That would be interesting. Or will the zone of support break down and we see another 3% down to this zone here, and then maybe you overthrow to that longer term trend line 3.5% lower, which would be around that 51.50 area. And then looking at the daily chart, you can see that downward price action. I thought we were going to spike here. We ended up getting one more down candle, and then we spiked, hit the trend, 21 EMA, broke down, hit the trend here. Now we're going to see if this gaps to that next one or not, pushes through to this next zone. That seems like a critical zone. Volume has been ramping, but you can see on that Friday candle, we did throw a big wick. Finished in the middle of the candle, held the trend. So that's a little bit of an interesting candle there. Definitely showing some buyers are hanging out in the zone. You can see this consolidation back here from mid-May. But again, if it pushes through there, probably headed down to this next zone, which you can see correlates with these lows here from the end of May and this consolidation from back here through April before we saw that bigger move down here. So interesting zone. We'll see how it plays. But if I had to pick one, I would say probably bearish, just with how much volume we've seen on this down move. Quite a bit more volume than we saw through here. Choppier volume, bigger spikes, ramping volume. Just does not look the same as this previous relatively shallow pullback before we saw that bigger move up. And then looking at the Tasty charts, you can see that upper ATR band, we overthrew it 2 months in a row. We got that big down month. So far for August, momentum rolling to bearish. Monthly support is all the way down at 452 on the S&Ps, so that's a lot of downside. You can see last time we hit this upper ATR, we did grind along it for a while. This was into 2022 before we saw that bigger move down here. And if you do look at it, it does look quite similar here. You can see September of 21, and then you can see that same candle set up here, April of this year. Couple of rally candles, down move here. And that month was the trigger for this longer term downtrend. So something to consider there. Am I saying it's going to happen? Not necessarily, but it does look like an eerily similar setup. Otherwise, in the short term, looking at that weekly chart, you can see trailing stop 522.27 seems like the same zone that we've been talking about, and that is the wick highs here from March as well. So right in the same zone, just seems like we're going to pull back to that area one way or another, and then we'll see what happens from there. If we get a little bit of a bounce, will it be met with sellers, and how soon will those sellers step up? It's also worth mentioning here, you can see once we were here, we were already into that bearish momentum, and really that hasn't happened yet. We were still bullish momentum for those first couple candles until this last week. Volume weighted MACD stepping down for the first time in a while on that weekly chart. And you can actually see that lowest ATR band starting to curl down. We didn't really see that until that last candle, so I guess it is still similar, but either way, doesn't look super great in the short term. And then looking at that daily chart, this is why I think we might see a little bit of a bounce. You can see we're already at that lowest ATR band. That's at 528.84. This is going to grind lower slowly. You can also see our vol spiking massively on those two down candles. So lots of volume happening. And usually when you see a gap down and a big wick rejection after a substantial down move, that volume coming in tends to be a little bit of buying action, closing those positions, closing short positions for a potential buy here. Something to consider. That would give you just a little bit of a short-term bounce, at least in my opinion. You're still in bearish conditions here, so we'll see how it plays over the medium term. But in the short term, I think it's possible we see at least a slight bounce. Moving over to the NASDAQ here on the monthly, you can see July was negative 1.63. So far in August, we are down 4.76. So far, not so great. Momentum rolling down, almost touched the 9 EMA there at 18,191. Trend support sitting down at 17,600. It's definitely been a run. We're definitely extended. You can see a wick rejection. So far, we have a confirmation down, so that's going to be not so great. The question is, does this structure start to break and you get closer to that 21 EMA? That would take a long time to happen. But right now, 9 EMA, that's your support, and then potential trend here. And then looking at that weekly chart, you can see we're right in the trend line area here. Momentum bearish, RSI bearish. So everything says this is going to break down. But it is worth noting, RSI, it's right at that 50 line. That's where we bounced last time. So markets are in that same zone, hit the 21 week, hit the trend, hit the 21, hit the trend. We'll see if it bounces here, very similar to this previous setup. It's worth noting this was more grinding, hanging out in the zone. This was more of a topping pattern with a big rally, hit the trend, very quickly pulled back from there. So I would argue that looks a little bit more bearish, arguably more similar to this July peak from the previous year, which did trigger a substantial down move, but ultimately resulted in higher highs to come. Not that overall bear market that we were comparing to on the S&Ps. And then looking at that daily chart here, you can see big down move. And really what I'm looking at is that 144 EMA. You could argue gap down, gap up, maybe see a little bit of a rally from here. That level is 447.31. Need that zone to hold. But right now, momentum is bearish, RSI is bearish. Again, huge volume on that gap down, which could be closing of the position, finished in the middle of the candle, indicating at least a little bit of buyers coming in there on the Friday session. Moving over to the Tasty charts, you can see June overthrew, July pull back to the level. So far, August hitting that 9 EMA. That's at 442.40. Low of the month so far is 444.47, so just missed it by about $2. You expect to touch it at least. Right now we're at 448, so that would give you about $6 of more downside. Momentum's been rolling down for a while, no huge volume quite yet. And then looking at that weekly chart, you can see we're already to that ATR support. Weekly chart still in bullish conditions. Trailing stop is 443.67. If that zone breaks, that's going to be the first time we've seen that in a long time. We got back into bullish conditions here in March March of last year. We've been on a bullish run, and we are once again testing that zone to see if we're going to stay in bullish conditions on the weekly chart. And then you do have the 34 EMA just below it there at 441.55. So right there, interesting zone on the weekly chart. And then looking at that daily, you can see downtrend definitely extended well below that lowest ATR. That's at 450.27. So again, hit the 144, extended in the short term, still bearish conditions, but volume coming in, all of the indicators of a potential short-term bottom before we see a relief rally and then probably lower lows to come after that. Moving over to the Russell here on the monthly chart, you can see consolidation top back here in August of 21 all the way through to January of 22. That was the bigger down move. We've been slowly grinding back up to that price action, hit this trend here in July, pulled back slightly from that zone. So far in August, 6.67% to the downside. Not super uncommon for the Russell. These usually have some pretty wide sweeping months, but at that level, that is a pretty big month already. Some of these other months around 10% lower, but bigger candles, basically right where we are now. 9-month moving average at 205. I think we're probably going to find some support at least in that zone, and then you got trend support sitting here at 202.65. Momentum did step to bearish so far. Obviously, the candle's not closed yet. RSI hovering in the midline, but still above the SMA. And then looking at that weekly chart, obviously terrible. All of the losses there. In that weekly candle, momentum stepping down, RSI bearish, volume bearish. But this is a zone where you would want to find some support if it's going to do it. 208.22 is the level. 9 EMA sitting there at 207.46. If that higher low is going to hold and we're going to see rallies, this is where it needs to happen. Otherwise, it's probably going to break down to that 200 SMA, which is sitting all the way at 197. So we'll see how it plays from here. And then looking at that daily chart, very similar setup to what we've been seeing. Huge gap down on that unemployment data. Do we see a little bit of a gap up, retest some zones, fill some gaps, and then we see a continuation lower? Or is this just the pullback where you see the big rally, consolidation, pullback, gap down, gap up, and then we see continuation to the upside once we start to see those rate cuts come in? There's definitely been a ton of volume happening through here. Most of that volume was happening on the up move. Then you can see some people exiting positions, volume kind of tapers a little bit, but now we got down move, volume coming back in. You would hope that that's some buyers coming in looking for that continuation rally. Moving over to the Tasty charts, looking at the weekly here, you can see upper ATR band was 230.30, came up just short of that. High of the week was 228.63, so we just barely missed it. We're back into the middle of the range. Again, 205 needs to hold. That's the current average. Volume coming in, but most of that volume was on the big spike up, so we'll see how it plays. Momentum did step to bearish, but we didn't have a huge push here. You would expect a shallow dip and then a continuation, just based off of the ferocity of that move. Something similar to this where you get a huge move, hit the upper ATR, shallow pullback, continuation, and we've grinded to higher prices since then. It is a big candle, did engulf the two previous and then about half of that third candle, but overall you would still expect higher lows there on the Russell. And then looking at that daily chart, again, huge volume coming through on the spike, not a ton of volume through here, and then big down candle, some volume, but not as much, and then big gap down, doji candle, volume coming in, momentum bearish. It did give us a switch to bearish conditions, which is certainly concerning. Upper ATR resistance is now 230.63, which is above all of these previous wicks. And then you do have that 55-day moving average, 206.75, almost touched that on the Friday candle. If it's going to hold, you'd really want to see that hold. That's above this consolidation here. And you can see June 12th, gap to that level around 206. Need that zone to hold if it's going to do it. And then looking at the Dow on the monthly, you can see 2.78 to the downside. Didn't quite hit that trend, pulling back here. Next level is 392.44. Momentum stepping down. RSI hasn't broken yet. 9 EMA sitting at 389.82. That's probably where we're headed at this point, at least somewhat of a test. We haven't touched that 9 EMA since all the way back here on 1 November, on that November candle. So it's been a long time on the monthly chart. And then looking at the weekly here, you can see 2.18, just barely missed that trend line, pulled back to here. 9 EMA sitting at 395.28, broke the level, tested VWAP, momentum stepping down, RSI bearish, volume bearish. So short term, still looks like there's going to be more follow through similar to this. Could be a wick down to the trend and then you see continuation, but you would expect at least that big wick touch the trend line, which is currently sitting at 388.95. And then looking at that daily chart, you can see big move, lower high setup, continuation lower, broke this level here, momentum bearish, RSI bearish. So everything says we're headed down to that trend line, and you can see it here. 392.44 could be interesting, but 144 EMA sitting at 389.42 is probably what we're looking for, at least over the next couple days. Moving over to the equal weighted S&Ps, you can see 1.75% to the downside. Retesting this trend line here, momentum bearish, RSI bearish, big volume. Everything says this is probably going a little bit lower. 164.87 is the next zone. Highly traded zone, 164.28. Low from this consolidation, 163.38. And then I have a level 162.57. So there is a lot of levels of support in this area. Could see some buyers come in here. But if this breaks down, you do have to look at the pattern as well. This was a sideways triangle, right? So you have a clear breakout, big wick, took out these previous highs, rejected from that level. And if you see a breakdown, that's now a fake out breakout, which is a bearish pattern. And then you would expect lower lows, or at least a test of that lowest level from that pendant, which is 157.70. And then you got the 55 EMA sitting there at 156. So something to consider. This could be just an initial move with larger downside to come, but there is a critical support zone through here, which needs to break first. And then you can see it here on the daily chart. Clear double top, big wick, took out all those levels, cleared the stops, and then we rejected very powerfully there on Thursday. Testing the trend line, testing these zones of support. Let's go ahead and extend out that trend line. Makes sense. Testing all those zones. Momentum bearish, RSI bearish, volume ramping. So still looks bearish in the short term. Still have that 144 EMA sitting there at 163.60. Again, right in the same zone of support that we've seen. Big volume through here. But if this is a true fake out breakout, then you should expect lower lows to come. Moving over to the ratios, looking at the SPY Russell and NASDAQ SPY, you can see the SPY Russell did underperform here. So the SPY outperforming, Russell pulling back slightly. I still think this is a top. You can see very clear topping pattern, big move up, clearly above all these previous, gave all of that back and then some below this consolidation, found support at 242. Now you're starting to retest some of those levels, and I would expect this to continue to roll down. So I think this short-term outperformance by the SPY is going to be short-term, and that the Russell will eventually get back into more normalized conditions. And we've talked about this a lot here. This is very, very extended, and it's been extended for a while. This rally really started all the way back here in February at around a 211 area, and then we've rallied all the way up to 270 or so, and now I think we're going to start to pull back. And then looking at the NASDAQ SPY, you can see 4 weeks of underperformance, getting into a zone of support here, potentially momentum bearish, RSI still bearish. So SPY was the top performer this week, but I don't think that that is going to necessarily continue. NASDAQ, I could see that continuing lower here as the worst performer, but I do think Russell is going to get back into that pole position out of the three major indices. Moving over to SPY divided by the M2 money supply, obviously it's going to look very similar to the SPX, but notice here you got a trend, got the 21, broke that 25.91 level, so that was interesting. That is a major level that goes all the way back to the dot-com era. This is super extended. Remember, the previous high that we've never maintained above is 2205. So if we see a pullback down to that level, that would be about 13.75% down from here, and that would bring you all the way back to the high from mid-July of last year. We'll see how it plays. You could start to see this structurally break 13.5% down, potentially momentum bearish, RSI bearish. So everything looks quite weak. You do have some trend in here. Let's go ahead and extend that out. That would give you some intermediate support around 2285, as well as that 55 EMA there at 2342. So maybe you find some consolidation here, which does correlate with this low from mid-April. But either way, remember 2205 is where I think we're going to get to eventually. This is considered bubble territory based on my metrics. Moving over to Apple and Microsoft, you can see Apple was positive on the week, just barely. They had decent earnings. They held those levels at 217.62, touched that level 2 weeks in a row, held it, 9 EMA holding. You do have some trend resistance basically right where we are, 219.45, and then next week that's going to be 220.35, so right in the same zone. Momentum fading, RSI fading, but structurally still looks better. 2 down weeks, holding the higher low. Consolidation high from the previous move was around 213.20, and then you have Microsoft looking like a Wyckoff distribution, consolidation, tried to break, quick rejection back into the consolidation, and then once this consolidation low breaks, which on a closing basis is 399.43, and then I have the level here 394.22. If that structurally breaks here, then you're going to expect much deeper cuts in my opinion, which could bring us back to these previous consolidation lows at 367.18 or so, which is back to this consolidation from November and December of last year. Moving over to Tesla and NVIDIA. Tesla is still holding this breakout. You can see that level is 188.50, long consolidation, big move up here on the 24th week, big continuation candle, started throw wicks, hit the trends, and then pulled back. Now we're waiting to see if this is going to hold a higher low. It's given a lot of this back, so that's not great. You would like to see it hold a little better. But 197.75, you can see the wick high from that 29 April week, right in that zone. If it does not hold here, we're probably headed back to the lows of that consolidation around 167. Volume has been huge, bigger volume on the rally, some volume on the selling. All of that volume has been bigger than the previous, so could go either way at this point. Probably a little bit more fall, but if it starts to break any more levels here, definitely concerned that we're going to fully round trip this move. And then looking at NVIDIA, 3 bear candles in a row, similar to Tesla, getting close to this previous consolidation high, which is 95.74. If this level breaks here, 106.64, we've been talking about that level for a while, overthrew it quite dramatically this week, and you can see 21 EMA 104.57, touch that level. If this breaks below those two levels here, 95.74 is in range, and then if that level breaks, my low of that consolidation is 84.03, with the mid-range at 90.63. So this is going to be the zone that you're looking at after that. Momentum bearish, RSI bearish, huge volume on this week, especially compared to the two previous down weeks. That could signal maybe a short-term bottom. Kind of fits with some of the other charts we've been seeing. But critical zone, once again, we're seeing that across markets, critical zone going into this week. Moving over to Meta and Amazon, these charts looked very similar for a while, but now they look very different. So Meta, positive on the week, 4.8, good earnings, big wick, almost hit the trend. You would expect a continuation higher in my opinion, momentum stepping to bullish, volume big there. Held this higher low from this previous low, you would expect to push to at least the same high, maybe a higher high, which would give you a price target around 540, 543 in that area. And then Amazon, terrible earnings, big down week, 8% down. We're watching this consolidation low at 174.23. If that zone broke, 55 EMA was the next level, which we did touch at 160.47. Now you have to wonder, is this cheap enough? I would argue probably not. Your next trend support would be down around 150. Once you get there, definitely looks a lot more interesting for me. Amazon in that zone feels cheap, and then you have that 200 SMA sitting at 145.65. So this zone looks a lot better. I would be patient here on Amazon. Probably some lower lows to come, but 145 to 153 seems like an area where even if you were to get a little bit deeper cut, I think Amazon's going to be higher than that in the medium to long term. Of course, that's a different thesis than if you're buying this to trade. If you're trading, obviously short-term bearish, and then be patient before you get into any kind of long position, waiting for at least some kind of confirmation to the upside. Moving over to staples and discretionaries, you can see staples continues to be on a run. It's looking like we're going to hit that all-time high here. 79.90 was basically the all-time high. You can see that wick from April of 22. The actual all-time high is 81.34. If 79.90 breaks, that's where I think we're going. And at this point, it does look like it's going to happen. Momentum, clearly bullish, RSI bullish, everything looks clean. Volume ramping, seems like staples is the place to be, at least in the short term. And then you can see it here on discretionaries, 3 bear candles. We saw a similar move here back in April. We're right at that 55 EMA, but momentum bearish, RSI bearish. I would argue that we're probably at least going to double bottom here down around 170.40. Doesn't mean we can't see a little bit of a bounce, maybe retest 180.10. That's been a super critical level. Again, kind of looks like distribution, choppy price action, tried to break. Failed breakout, back into this consolidation, and then if that consolidation low breaks at 170.68, and then you could even look as low as that October low, down around the 148, 149 area, which is a very substantial move lower from here. So I'd be patient. Doesn't mean we can't get short-term bounces during that time, but this is a super critical zone once again. Moving over to transports and industrials, talking sectors that I have not looked at for a while. So we got transports down 3.96% on the week. We're at this trend line here. It's marked a lot of critical bottoms. We've tested it 3 times here just over the last couple of months. And now we are here once again. If this breaks, you got the 200 sitting at 61.09, and then if that level breaks, there is a lot of room here to the downside potentially. Momentum bearish, RSI bearish. I think honestly we're probably just getting started here. So you can see the pullback, test of the 21, bigger pullback. Once that zone breaks, I think we're headed much lower. And then industrials. Look at this chart. Massive run up, clearly distribution, clearly fake out breakout. Now we're looking to see if this 120.49 breaks. If it does, I think the 55 EMA is the next spot. You're going around 114.58. And then if that zone breaks, there is a ton of room down to 104.50 as your next EMA. Sure, there's a ton of consolidation areas in here, and you can see the volume in that zone. But look at the volume here. Huge consolidation, ton of selling happening in my opinion. Look at that volume. Continues to ramp on the selling, and honestly it's quite unnerving to see how much distribution across multiple sectors that we're seeing. Moving over to commodities, I want to look at something different here. So this is the Global Timber and Forestry ETF, or wood, by iShares. And then overlaid with that, I have the IWM. It's a very similar chart, but you can see there are some slight differences here. So you can see that consolidation that we had on the Russell for a long period of time. Russell started breaking down, and then you can see wood followed. So the Russell was actually a little bit of a precursor there. And then you can see we're basically in lockstep. Wood moving lower, Russell held a basically double bottom. Gave you a little bit of a foreshadow there for wood getting a little bit of a bounce. Then you can see in lockstep, higher high, pulled back to that level. Wood pulled back to a deeper low, got a consolidation run, and then you're back in lockstep here. But the interesting thing, and the reason that I wanted to talk about it, is if you look here, you can see wood establishing a lower high, got the same breakdown candle. If structurally it starts to break down, maybe we could be seeing wood give us a little bit of a leading indicator, whereas the Russell made a higher high, wood made a lower high. The question is, does wood hold that same bottom here and come up to meet it? And then we see a continuation higher here. Or is wood giving us a bit of a precursor that the Russell is going to break down and move to some lower lows? Typically, these come back together at some point. You can see it every time they got disjointed, they did come back together. Clearly disjointed, came together. Clearly disjointed, came together. Similarly here, lower lows holding, and then we came back together. Clear differences. Will they come back together to that lower low? Seems kind of likely, which is an indicator of some potential bearishness in the Russell to come. Moving over to breadth, 20 and 50-day breadth. As you would expect, both of these rolled down aggressively. And really, they'd been holding up quite well despite the kind of weakening price action that we'd been seeing, which to me, again, is a little bit unnerving. So we have a big breakdown on both of these. Clear top, 20-day breadth was in a zone of resistance. Couldn't quite get to those extreme levels. So maybe that means we're going to hold a slightly higher low potentially, but still you should expect to get down to those previous lows around 32, which would be at least one more week of down move. Momentum stepping to bearish, RSI breaking down. Similarly on the 50-day breadth, you have a low, you have a high, lower high, and now we have another lower high. And with a low, lower low, and the question is, will this be an even lower low down around the 26 area? That could be an interesting move, similar to one of these really powerful down candles of 42%. This candle was down 20%. That other candle leading into that big down move was around 14.5%. So seems to fit with the thesis, which ended up leading to 3 weeks in a row of down move and did pull us down to that 26 zone. So seems likely that we could get another move like that coming off of that really big down week. And then even the previous time we had a big down week, the next candle did have a big move down before we got a little bit of a bounce. So either way, probably another wick to the downside, and then you could look for a bottom, or potentially super aggressive down to that much lower low around 26. Either way, I would expect some lower lows to come before we see a bounce. Moving over to 200-day breadth, you can see big down candle, 8.7%. Usually those are followed up with another big down candle, similar to here, of about the same size, another 9% down. That would take us into that 58 area, 62 area, around the 200, sitting there at 61.61. So in this level here, momentum bearish, RSI bearish, so nothing crazy. Everything continues to look bearish, but it is worth noting this 200-day breadth has held in there quite well. The lows are basically all on par with that 64.74 area. All of the highs have been right here between 76 and really that 82 area. So again, We're definitely in consolidation, waiting to see if we get a break of this zone here and then we get a bigger move down, or if this is just going to be another dip consolidation with slightly lower highs on a closing basis. Moving over to the put call ratio, I wanted to highlight this one because we did touch our first level at 1.4. That's an interesting zone. You can see it's not super extended. 1.6 is a little bit more reliable. Once you start to touch those levels, you start to see some decent pullbacks on the put call ratio, but we are getting up there. Nothing crazy, but starting to touch those upper levels. You can see we were hovering around 0.63 for a while. Now we're at 1.4, starting to see those levels. Probably one more. Probably going to touch at least 1.6. And then if we start to get into that 2 zone, that to me is where we're going to start to see some cleared bottoming. So not quite there yet. I would expect at least 1, maybe 2 more candles here on the weekly chart. And then looking at that daily chart for just for a minute, you can see consolidation, starting to see some ramps. Got to that level, big gap, big wick. Not price action you see super often on the put call ratio, so something to consider, but it still looks like it's going higher in my opinion. Moving over to the dollar here on the weekly chart, you can see down 1%. Turns out this was another high, lower high setup, and now we have a low, lower low setup. Clearly a different structure. We did have a high, we did have a low, higher low here, and now you have a low, lower low here. So at this point, you would expect any kind of buying price action to be met with sellers, and I wouldn't expect a bottom before we at least got to 1.27, this previous low here from March, but realistically 1.2 seems like the level. I did have some trend lines in here. I extended those, which also brings you down to that 1.2 area sometime in the next week or 2 weeks. Then we'll see what happens from there. Momentum bearish, RSI bearish. Pretty unusual to see the dollar falling with equities falling, but that is usually what you see when you start to price in some recessionary effects, recessionary conditions. Moving over to yields, obviously these cratered 11.4 and 9.5%, so 2-year continuing to fall faster than that 10-year. We're still seeing that re-steepening coming through, and they're pretty close now. 3.88, 3.79, within just a little bit of each other. I think we're going to get there within the next week or two. You can see 10-year hovering right around these lows back from December, whereas the 2-year much lower low from that same zone. 2-year looking like it's going to hit that 144 EMA in here at 3.786, and then 10-year 3 3/4 is the level, just barely hanging in there. Of course, momentum and RSI on both of these is bearish, but the 2-year is oversold 28.38, and then you can see RSI here on the 10-year 34.27, so a little bit better strength on that 10-year, which does make sense. Moving over to bonds, JNK and TLT, very different story here. JNK down 0.79. Again, consolidation, big wick low, big wick high. We're back into the middle of the consolidation. At this point, you would expect that this is going to go lower. Tried to break out, couldn't do it. Makes sense with JNK being more based on economic conditions, which are now considered to be quite a bit weaker with the unemployment rate continuing to climb to 4.3. And then you got TLT here, massive up candle, 5.69%, probably headed back to the $100 level. And you can see momentum bullish, RSI bullish. Everything continues to be bullish. I've been bullish on the macro here on bonds for a long time. I've been averaging into these in my retirement accounts for a long time. Now it seems like that is starting to pay off here. I think we're going to head back up to the 100, potentially back to that 103 area here, which is prices we haven't seen since all the way back in June of 23. I think we're going to get there. We'll see how it plays over the medium time frame, but this just looks super bullish. You can see the rallies we got here. Did consolidate and pull back deeply, but we held the higher low. Seems like we're going to get there. Again, not so much a trade, but more of a longer term investment. Moving over to volatility, move index climbing, 144 EMA there. You can see low, higher low. Looks like this is going to head up here, potentially into that 125 to 127 area. Very strong candle. You would expect at least another wick similar to this. So bond volatility, interesting there. And then looking at the VIX, obviously a big up move, 42.74% on the week. Huge candle higher. We are overbought, not something you see super often here on the VIX. We're above all of these trend consolidation, all of these trend lines here. And what we talked about on Friday was this wick high back from March of 23. The actual high on that candle was 30.81, and we just missed that on this candle here. High this week was 29.66. I would expect at least one more candle of up just like this, where you get a big up candle, second candle at least in the same zone as that previous wick high. So 1-2 more candles touch that zone. Then you could see a pullback with the next candle, slight wick high, bigger pullback down. So we'll see how it plays. can absolutely hang out in this zone for just a couple of weeks before we see that start to move back to more normalized conditions. But this is pretty high now. I don't think we're in full capitulation yet. 1, maybe 2 more weeks in this zone, and then we start to see bigger pullbacks on the VIX, signaling a little bit of a relief rally, at least in markets. Moving over to my accounts, you can see I lost basically the same as markets this week, which I do hate when that happens. Most of my trading philosophy is based on the fact that I lose less than markets and make about 3/4 of the gains when they go up. So when I lose the same as the market, that is not a great indicator for me. But that is what happened. I lost basically the same as markets, which is unfortunate. In terms of positions here, I still have a covered call on the IWM. I think there is still potential for a slight bull trade on that position. Needs to hold the higher low if it's going to do it. We're at the critical zone. I think a relief rally is possible just based on how little data we have to push around markets. Hopefully all of that weakness is priced in now. We're definitely extended on the short time frames. And then looking at the Qs, basically the same thesis, being very cautious here. Sold at 442 and 443. Big credits on those, $1.57 and $1.77. So over $300 credit. And that is more than 1% out of the money with no major news coming in on Monday. So hopefully we can see just a little bit of a bounce. I don't think any kind of bounces, at least for now, are going to be extended or any kind of change in structure. I just think we're a little bit short-term extended with volatility being a little bit high. So we'll see how it plays, but very, very cautiously bullish going into the Monday session. Let me know down in the comment section what you think of the spread between bond yields. Are C notes telling us something, and are B notes going to catch up and give us that recessionary indicator? Otherwise, like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.